enable them come up with standards that are consistent. In order to enable them come up with standards that are based on consistent consistent principles and concepts, they need a baseline. They need some bit of a base where to look whenever they are coming up with a standard. And that is the framework that we are trying to look at. We say that this framework is made up of 8 topics. We looked at some of them, and we said that these topics are like floors of a building. One builds on another, and it depends on the other. So by the time we reached recognition and derecognition. To start with, recognition and derecognition is relating to elements of financial statements. So meaning we looked at what we call elements of financial statements. Elements, it means what makes up financial statements. And financial statements, it is the financial information which was derived from our objective. Remember, the entire objective of anyone and everyone who is going to study financial accounting, financial reporting, and advanced financial reporting is to provide financial information about the reporting entity. That financial information is about the reporting entity, and making sure that the information that you're providing about the reporting entity is useful to both existing and potential investors, lenders, and creditors, and other users perhaps in making decisions. So it is financial information. Which financial information? For now, we say that we are going to limit it to financial statements. So these financial statements, they are what the company or any entity that is either required or chooses to prepare them should have. It is a set of 5. Say that we have a statement of financial position, statement of profit or loss, another comprehensive income, the statement of changes in equity, statement of cash flows, and then the notes to those financial statements. But since we are coming up with financial statements, we need to know what is embedded in those financial statements. And we said that it is elements that make up financial statements. Those elements are 5: assets, liabilities, equity, incomes, and expenses. We also looked at the definitions of assets, liabilities, equity, incomes, and expenses. We agreed that if you understand the 2 of them, like assets and liabilities, then you can easily explain the other, because others come from those 2 other elements. It is principally 3 elements that actually make up this entire information that we are trying to talk about. That is assets, liabilities, and equity. Incomes and expenses fall in there. I think we are going to see later on today when we are looking at the accounting equation, how that makes sense. So, having understood what elements are, what assets are, then we say that we ask ourselves a question: if I have my small business or a business or a company, and I mean, I'm on a journey of preparing financial statements. To start with, my question will be, what should I put in those financial statements? So after answering that query, or sorry, that question, what should I put in my financial statements? Those are elements: assets, liabilities, equity, incomes, expenses, depending on the statement that you're looking at. So after understanding that assets are going in my financial statements, then should I just put in anything that is called an asset? There must be a criteria for recognition or for inclusion of that asset or a liability, income, expense, equity in our financial statements. We said number 1, before we even look at the criteria, that particular item must meet the definition of one of the elements of financial statements. To start with, that if I'm looking at an asset, before I even ask myself whether I should include it in my books or not, my first question should be, does it meet a definition of an asset? I don't want to be caught in a scenario where I get an expense and I call it an asset. So you need to, first of all, make sure that that item meets the definition of one of the elements in the financial statements. Then after that, you can go ahead to the recognition criteria, where we are saying that, number one, it must be probable that any future economic benefit associated with that item shall flow to the entity. It is probable that any future economic benefit shall flow. So if this has been satisfied, then I can include in my financial statements. But it is not the only one. There is another one, that the item's cost must be able to be measured reliably. It must have a value attached to it. If we cannot ascertain a value for that particular item, then it means that we cannot recognize it in our financial statements. We cannot include it. And the reason is very simple. Financial statements are monetary. Financial statements are what? Are monetary. If we cannot attach monetary value to an item, then that item should not be included in our financial what? In our financial statements, as simple as that. All right. Then we say that this recognition criteria, it is so perfect for assets and liabilities. For assets and liabilities. If it is an asset, it is probable that any future economic benefit associated with that asset shall flow to the entity. If it is a liability, then it is probable that any future economic benefit associated with the item shall flow out of the what? Out of the entity. That is for a liability, because it is a present obligation. Are we together? It is a present obligation. But settlement of that obligation will require us to part with an economic resource. That's why we are talking about something going out, to settle it. Then the asset or liabilities cost of value must be able to be measured reliably. Now, after knowing how to recognize an asset and how to recognize a liability, then it becomes very easy to know how and when we should recognize an income or an expense. Because we agreed that incomes, to start with, are an increase in an asset or a reduction in a what? In a liability that leads to an increase in equity. Isn't it so? So for it to be an income, it must increase equity. But as it is increasing equity, we have to make sure that that increment is not associated to owners. Are we together? Because equity can be share capital or any other contribution by owners. If an owner increases capital, it increases equity. But that increase in capital is not income. It is not an income, it is capital. Are we together? So that's why when we are defining an income, we are saying that it results as a result of an increase in an asset or a reduction in a liability that increases equity other than contributions from the shareholders or the owners of that company. So if I know how to recognize an asset, then it will be easier for me to know when I should recognize an income, because that income comes as a result of increasing assets. Are we together? And reducing liabilities, meaning de-recognizing a liability can as well lead to an income. Are we together? For as long as you exclude whatever relates to the owners. And then expenses, it is the other way around. An increase in a liability or reduction in an asset that leads to an overall reduction in equity. That part is very key, more so where we are going in the double entry system. That part is very key, and I will be referring to it as many times as possible, because that's where it starts from. If you understand it, then everything is going to be very easy. Derecognition, we derecognize an asset, and derecognition means doing away with an asset or a liability. Are we together? So we derecognize an asset if we no longer have control. If we no longer have control. If the entity loses control, then we derecognize the asset. And then for the liability, if you no longer have a present obligation. If the present obligation disappears, then also do away with the liability. All right, that is it. Then going back to our question is that we want to prepare financial statements. The financial statements has elements that we have looked at, and those elements we have seen how to recognize them. Now, after knowing that this is a car, and this car meets a definition of an asset, yeah, it meets a definition of an asset. Then after meeting a definition of an asset, I have gone, checked the recognition criteria, and I see the car actually fits to be recognized in my financial what? In my financial statements. My next question is going to be, at what value should I include it in my financial what? In my financial statements, because they must have monetary value. Now, being that this is a framework, it doesn't limit you. It gives you a number of measurement what? Bases. Different bases for you to choose from. So depending on a standard, a particular standard that has been issued by the International Accounting Standards Board can point out just one basis. Are we together? It can pick just one what? One basis of measurement. For example, inventory, and they tell you that please, when you are recording that inventory after buying it, let it be recorded at historical cost. Are we together? So as and when the standard, we look at a standard, the standard will be able to guide us that this particular element, how should we measure it? This particular element, how should we measure it? However, this is not a level for standards. A level for standards, that will be paper 7. So standards will much more be looked at level 2, paper 7. This level is for basics, but we need to understand where those basics are coming from. So the measurement basis, meaning how can we measure, in how many ways can those elements that we have talked about up there be measured in our financial statements? Meaning that it can be an asset measured at historical cost, or it can be an asset measured at fair value, or it can be an asset measured at a value in use. Are we together? It can be an asset that is measured, that is measured. Are we together? It can be a liability measured at, depending on what the board actually wished to come up with or to solve. All right, the first basis is historical cost. It is historical cost, and most of our assets, most of the assets, when we have just acquired them, they have to be measured at historical what? At historical cost. What we call historical cost, it is that price at the date of the transaction. So when I was acquiring that car, what price did I buy it? Are we together? So if I want to include my asset in my books, if we are to move a step further in terms of levels, what we are looking at to prepare actual financial statements, somewhere, somehow, I'll ask myself, what standard governs an asset like a motor vehicle? Then it will take me to a standard, for example, IAS 16, that if I want to recognize it, I'll go to IAS 16. IAS 16, which is the standard governing such an asset, it will take me through whatever we have looked at here, but in a much more specific perspective. It will give you a definition of that particular item. It will give you a basis of recognition and a basis of derecognition, and then it will also give you a basis of measurement. But it will not give you all of them. It will just pick one, that an asset at the point of acquisition it must be included in the entity's financial statements or in the entity's records at historical what? At historical cost, full stop. Because it doesn't need to give you all these. These are given by the framework, so that when you're coming up with a standard, pick from them. Are we together? So that is it. Historical cost is the price that, at what price did I purchase that particular item? That car, I bought it, or I have bought it at 20 million. Meaning, in my books of accounts, I am going to recognize an asset called a motor vehicle at historical what? At historical cost. Meaning, I'll go to my books, whatever books we shall see in the future, and I say that I have an item called a motor vehicle. What is the value of that motor vehicle? It is 20 what? It is 20 million, because the 20 million is the historical what? Is the historical cost. Are we together? That is it. Then another basis is called current value. Now, current value, for it, it reflects current situations, the current changes in a what? In the market. And it has the following bases beneath it: fair value. So a standard can come and it tells you that when you are measuring this particular item, measure it at fair what? At fair value. Now, what fair value means, by definition, is a price that you could get if you're to transfer that asset, or what you would pay to transfer a liability, to transfer. Number one, the price that you would get if you're to sell that asset in the market, or the amount of money that you could get if you're to transfer a liability. But that must be within or between market participants at a certain measurement what? At a certain measurement date. Ideally, what they are trying to say that if you sell that car in the market right now, what can I get? Are we together? If I'm to sell it, what can I get? Guys, let's mute. Patrick, your environment is distorting ours. So what can I get if I'm to sell it? Are we together? Reflecting current market conditions. I'll give you an example. An example, we have a standard, a certain standard called investment property, IS 40. It specifically looks at land and buildings that are held for capital appreciation and rental. Are we together? You buy your land, you're not going to use it for anything, but you're just keeping it. Are we together? So that it raises in value and you sell it in the future. Are we together? Now, such assets, that is an asset. Land is an asset. But that particular standard tells you that you have to make sure that you report that asset subsequently at fair value. Are we together? So you're going to report it at fair value, meaning at every time you're going to prepare your financial statements, you have to ascertain how much that land could be sold in the market. Are we together? So that you keep telling us the actual value in the what? In the market, in the financial statements, in order not to mislead the users. So such an example like that. Then we have what we call value in use. That if we are to maintain this asset up to disposal, what can we get as benefits, as cash inflows from it? That if I'm to have this machine, for example, I have bought it, I'm going to use it to manufacture maybe kombucha. So if I'm to hold this machine up to the time when I'm to dispose it, what cash flows do I expect it to give me? Those cash flows that you expect that machine to give you in the future, discount those cash flows to the current what? To the current date. And by cash flows, I mean that maybe this machine will give you, you will use it to produce bottles of kombucha and you sell them. Are we together? If you sell them, you will get revenue. Now that revenue, you discount that revenue. Discounting seems to be some sort of a new word, more so if you have not yet done quantitative techniques. But discounting is simply trying to factor in time value for money. Are we together? That if you're anticipating to get 6 million next year, that 6 million next year cannot be 6 now. Are we together? It has to be something less now, because money now has more value than money then. Are we together? So that is what we call a process of discounting. That if you expect 6 million in the next year, discount it to the current date, reflect its worthiness now. Are we together? So that is what we call value in use. And still, all these methods, you'll be looking at them in paper 7. Then current cost. Current cost, and what is the cost of an equivalent item or an equivalent asset, an asset of the same nature. Then net realizable value. The net realizable value, this one is a bit closer to what we have looked at, but for it factors in the costs to sell. That if you're to ascertain the net realizable value, kindly get the price that you would receive if you're to sell that item, but deduct costs to what? Costs to sell. Like, for example, I have a car. If I want to get its net realizable value, then I would ascertain how much would I sell it in the market. Then I put in assumptions. If I'm to sell it, will the buyer come where the car is, or I have to transport the car to the buyer? So there are some transportation costs. Are we together? Will I get the buyer myself, or I'll have to engage a broker? There are brokerage fees or costs. Are we together? So you put all those into consideration, less them, what you get will be the net realizable what? Will be the net realizable value. And then the present value is so much similar to the value in use. Still, it also looks at discounting. And we are also discounting future cash flows. So it is a standard that will show you, or that will guide you, that in such a scenario, such a situation, you're going to use this value. It is not something that we just guess. It is a standard. Unless a standard is silent, which is so hard, But if it happens that a standard is silent, then we may need to use judgment. Are we together? But either way, when you're using judgment, if a particular standard is silent about that particular item, your judgment should be based on the conceptual what? Should be based on the conceptual framework. Are we together, guys? All right. So we have seen how to measure, meaning that where we are right now, you know that this is the definition of an asset. You know that it is worth including in my financial statements. You know the value with which you should include it. Isn't it so? Then our next question is, how is it going to look? How should I present it in those financial statements? Are we together? How should I present? Should I present the way I want? Are we together? I don't know. Guys, are we moving at the same pace? Or I'm speedy? Eh? Am I? Kind of. If someone says kind of, then it means that it is confirmed. So meaning I'm speeded. But when you see that I'm taking you at a great speed, you tell me, you tap on me that you're going at a very high speed. So that I somehow, yes, you're speedy. Patrick is saying that I'm speedy. Okay. Let me try to turn down the speed. But you know, when you're used to something, it is hard to maintain it. That's why I'm saying that when you see me going at a faster speed, please tap on me. And also English is not an easy language. So if you capture your words that you're going to use in a statement, you use them very fast before they disappear. So you also factor that in, that we are using a foreign what? A foreign language. So Tracy is saying that come again on present value, please. If you really understood value in use, then present value is going to be very easy. Because if you are to measure an item using the present value, still you're going to look at its future cash what? Its future cash flows. Cash flows includes cash inflows and cash what? Outflows. But remember, you're looking at projections and expectations. They are not real. What you expect in the future. Then after you do what? You discount them. Are we together? If someone says present value in actual sense, in the word present value, there is a meaning discounting. There are two values. Those who are doing chuti, I think they have already looked at it, I guess. No, maybe not, maybe yes. We have what we call a future value and a present what? And a present value. A value in the future and the value at the what? At the present. Now the value in the future and the value at the present, what differentiates them? They are relating to the same thing. For example, I have revenue that I'm expecting 2 years from now. I'm expecting revenue of 2 years from now, in 2 years' time, of 10 million. Now, if I'm to report to someone that I'm expecting some money 2 years from now, right now, I cannot tell them that I'm expecting 10 million or that I have a receivable of 10. Are we together? It would be prudent. I discount it now. Are we together? To show its worthiness at this date. Are we together? Since such an item falls in a balance sheet, if it falls in a balance sheet statement of financial position, which is a statement as at a certain date, then it is best for it to represent values or to if representing. Okay, yeah. It's best if it represents values that try to depict current situation. Yeah, that is it. That is the logic. So moving from a future value of 10 to a present value, I have to do a process. Yet, if I'm to move from a present value to a future value, I have to compound it. So that is it. I think this is Rhoda. Rhoda, in our video, you're unmuted. I don't know if you have something to say. All right. So I think we can move. I think we can move to presentation now. To presentation. Now that I know that I have to put the asset, I know its value, where should I put it? Or how should I include it? IAS 1 is a standard that governs on the presentation of financial what? Financial statements. How should the financial statements look like? Are we together? It is a standard called International Accounting Standard 1. It guides on that. But remember, it was also gotten from the conceptual what? From the conceptual framework. For it is much more wide, but the conceptual framework is a bit compressed because it doesn't have to be so big. Now, the conceptual framework tells you, number one, it tells you about classification of assets and liabilities. That when you're presenting your items of assets and liabilities, Rhoda, please remove your video. Rhoda, kindly remove your video. All right. So what we are saying is that The framework is telling us that we may need to classify our assets and what? Our assets and liabilities. And classification is in terms of telling us that some of these assets or some of these liabilities relate to a long-term what? To a long-term period. And some of these assets relate to a short-term what? Relate to a short-term period. Now, that is classification. So you may need to classify more so you may need to classify more so if the entity is a going what? Is a going concern. Are we together? Meaning we are expecting the entity to be in existence in a foreseeable future. In such a case, you may need to tell the users that this money that I have reported as liabilities, part of it shall be settled in a period of more than 1 year, yet the other part, I will have to settle it in a period of less than one what? Period of less than 1 year. Then offsetting. The framework is cautioning us about offsetting, because someone can look at assets and liabilities and they may want to offset them. I have assets of 20 million, I have liabilities of 5 million. Someone just reports net assets of 15 what? Net assets of 15 million. So the framework here, it is telling you from the onset that, please, you have to tell us all the assets. You have to present all the assets and also present the liabilities. Don't offset. Meaning you're not allowed to knock off liabilities from what? From assets, and you just present the net assets. That is wrong. However, in certain minimal scenarios, offsetting may be allowed, but very slight scenarios. But a lot of caution must be taken in terms of offsetting. So, first of all, assets shall not be offset, liabilities shall not be offset from assets. And the same, even expenses shall not be offset from what? From incomes. Now, people tend to misunderstand the concept of offsetting and the financial statements. Because the financial statements, of course, to get a profit, you'll have to get your incomes minus what? Minus expenses, not so? That's when you will get a profit. Now, someone might ask, that isn't that one offsetting? Now, that is not offsetting. What we call offsetting is someone to get expenses and they knock them off from incomes and they only present the remaining. Are we together? In such a case, you're not faithfully representing what you purport to represent. For faithful representation, you have to make sure that you show us all the incomes that you have made. And then you also show us all the expenses. Then you show us the remaining. Are we together? That is faithful representation. You have a question? So that is it. And then materiality and aggregation. Now, materiality is, I think I talked about materiality. To start with, you have to make sure that each material class of an item must be presented and separately. So items that are material should be presented. You should show them separately. Immaterial items can be aggregated. Are we together? Immaterial items can be what? Can be aggregated. For example, I have employees. These employees, I pay them salaries. Are we together? I pay them what? Salaries. Now, in addition to salaries, I give them some breakfast. Are we together? I give them some breakfast and whatever, plus those other small costs that are related to employees. Now, I can simply just aggregate all those costs because they are relating to employees, and I call them employee costs or staff what? Or staff costs. In such a case, I can aggregate. But now, you cannot come and you aggregate, for example, salaries and wages, and then you have also another cost where one of the employees took the company to court. Are we together? One of the employees took the company to what? To court. And then the employee won the case and we gave the employee some damages. Are we together? Of a substantial amount. And then someone says that, let me add that figure to salaries and what? And wages, and I call it staff costs. Now that one, you're not trying to faithfully present what you're purporting to represent. Are we together? Because a user needs to understand. They need to see that you incurred some legal costs, that you incurred some such costs that you paid out of the legal system, that even a company was even sued at a certain point in time. As owners, we need to know that. So you may need to present that one separately, either in the financial statements or in the notes to those financial what? The notes to those financial statements. Now, accrual basis of accounting. Now, the framework tells us that as we are preparing financial statements, these financial statements shall be prepared using or basing on the accrual concept. Now, this accrual concept, I think we are going to look to appreciate more about it. But the accrual concept tries to bring a certain scenario at hand that you don't have to wait for cash to come in for you to recognize an element. Are we together? If you have made a sale, you don't have to wait for cash. For you to receive cash, for you to say that you have made a sale. A sale is recognized as and when it has been made, not when cash actually exchanges what? Not when cash actually exchanges hands. Are we together? So for any transaction, as and when it has occurred, if that transaction has occurred, if it is a liability, and that transaction has occurred, the entity has an obligation. Don't wait. If it is an income, don't wait for when the client will pay you. Recognize the income now, and you rather tell us that you're expecting somewhat. You're expecting some money. That is what we call the accrual basis of what? That is what we call the accrual basis of accounting. Then the frequency of reporting. The frequency of reporting, number one, it is a period that is at least what? At least what? At least annually. But the framework, even the standard IS1, does not stop from an entity, does not stop an entity from preparing financial statements of less than 1 year or even more than 1 year. But if you do that, you have to make sure that you do what? You disclose it. You tell us the reason for using a longer or shorter what? The reason for using a longer or shorter period. And you have to also tell the users that the amounts that you have actually presented in those financial statements are not what? Are not comparable. Are we together? Because if you prepared financial statements last year for 12 months, and this year you're preparing financial statements for 8 years, those two cannot be comparable, are they? So that's why if you choose to prepare financial statements of a period longer or shorter, you have to disclose it. Are we together? Most of these things we are looking at, you'll appreciate them further when we go to paper 7. They may not be at this level, but the definitions of them and understanding of them, you need to have it because it is part of the syllabus. And then consistency of presentation. Please, I think we even talked about, we talked about consistency before, but when you choose to adopt, for example, a certain accounting policy, you have to make sure that you apply it consistently so that those financial statements are consistent. Where there is consistency, there is ease of comparability. Are we together? Where there is consistency, there is ease of what? Of comparability. And if you choose to go with a certain accounting policy, then that must be the accounting policy that you choose. You have to apply it consistently for over and over the years, unless the change has been permitted by a new standard. Are we together? If a standard comes and it says that what you have been applying this way, please apply it that way, then you can switch. Or if the change actually brings a much more better faithful representation. So that is it. Finally, I hope we are okay with the presentation and disclosure. Any question? Do we have a question? All right. The concepts of capital and capital maintenance. Now, this one tries to help the preparers of financial information, financial statements, to distinguish capital from income, from profit. Now, I think this thing is even very hard practically. So you find very many people operating businesses, and it is very hard for them to distinguish between capital and what? And profit. Isn't it so? Doesn't it happen? You find someone, they don't know their capital. Profit, capital, it is all the what? It is all the same. Now, here we are in the concept of capital and capital what? And capital maintenance. It is called capital maintenance because for going concern, we have to make sure that an entity is making profit. Because if you're not making profit for 1 year, 2 years, 3 years, 4 years, then it means that you're going to run short of funds to clear your obligations. How are you even going to operate when you're operating in losses? It means that it is capital that is actually being eaten up. Are we together? So it is very important to understand this concept. And the framework brings out 2 concepts of capital. There is capital in its financial terms, and then there is capital in its physical what? In its physical terms. Capital in its financial terms is that money that you actually use to start the business. I have started that business with 50 million. That is what we call a financial concept of capital. The 50 million or its bargaining power, what that 50 million can get you in terms of assets, is what we call the financial concept of what? The financial concept of capital. Yet on the other hand, we look at the operating capability. We look at the operating capability. And the operating capability can be looked at like in terms of units of output in a year, in a month, in a day. Are we together? Now, someone can look at capital in terms of operating capability. If my operating capability at the end of this year is more than my operating capability at the beginning of the year, then it means that somewhere, somehow, I have made a profit. If I didn't, or if the owners did not include anything more in that business, I don't know if it's if it actually makes sense. If our business is for example manufacturing, I think it is manufacturing of juice, and that juice we sell it in bottles of 300 mLs. Are we together? That is our business, to manufacture juice. We put that juice in bottles of 300 mLs and we do what? And we sell. What we call the physical concept of capital is the operating capability. That if I start with 50 million, at what capacity can the 50 million take me? Can it put me? That in a year, using that capital 50 million, I can supply 30,000 bottles of juice. Are we together, guys? So if I maintain the same capital next year, and by the end of next year, my capacity is that I can supply 50,000 bottles of juice, then it means that somewhere I have made a profit. Isn't it so? If my capital remained the what? Remained the same. Are we together? So that is what we call capital maintenance, to ascertain profit from the concepts of capital. Are we together? But it will be profit if, for example, in our example that I've given, it can only be profit if the owners have not injected anything what? Anything more. But if the owners have injected anything more, then it means that what you are counting as profit could actually be relating to the contributions from the owners. Are we together? So that's why when we are looking at physical capital maintenance, we are excluding any distributions or contributions during the what? During the period. Is it understood? Guys, is it understood? All right. Online people, are we at par? Guys online, are we at par? Are we moving together?
We at par, yes.
You know, studying online is hard. Studying online is hard. People study when they are in the bed. They are covered more. So you wait. Within the semester, we are going to see changes. The weather is going to change. We are supposed to have a class at 6. It rains. And in the class, we shall have only like 3 people. Very many people are online with the blankets. They are with blankets, then they have like a small, the phone is like this. They are there in the blanket inside, watching the screen of capital and capital what? Of capital and capital maintenance with no book. So online studies, sometimes you have children. There are very many. And as you're studying, you're cooking. So whenever we call out online people, please hurry to respond. Otherwise, we may think that we are alone. All right, I think that is it. That is where we stop with our conceptual framework. Those are the 8 chapters that we promised to look at. Please don't forget that we said I gave you some bit of like a small assignment. I know this level we don't normally like assignments and research assignments. But what we normally give, they are things that are manageable. Forms of businesses, make sure that you know them. Because we looked at the reporting entity, but we didn't look at the forms of what? The forms of entities or businesses. In terms of sole proprietorship, partnerships, and then liability what? Limited liability companies, both private and public. Are we together, guys? And as you're looking at them, the definition of each of them is very important. Advantages and disadvantages of each is also very key and very important. And where possible, the characteristics. For example, a sole proprietor has characteristics that are different from the characteristics of a partnership, isn't it so? You limit yourselves to only those 3, because it is only those 3 that were brought up by this on the syllabus. But if you wish, you can extend. But if you understand those 3, of which some of the information is in the notes, then you'll be good to go. All right. We are going to have a break of 10 minutes. Then we come up with the accounting equation and double entry. Okay? Now we are going to start actual and real accounting now. here we have been trying to understand the few concepts and regulations here and there. Now the actual accounting is going to start with the accounting equation and double entry, and that is going to be 10 minutes from now. That is at 7:22 or 23 there.
My head.
What is it?
My head.
What is wrong with you?
It's burning.
Take medicine. Drink medicine. First take medicine so that it stops pain.
Right, I think we can continue. So we are saying that we are going to unleash our what I will call our second topic, and that is the accounting equation and double entry. This is going to take us some good time just to try and appreciate it, because this is the backbone of accounting. I hope guys online, you can get me clearly.
Yes, we do.
Guys, can you get me? Okay, I have a reply. All right, guys, if you have to go back to our conceptual framework, and specifically the objective. The objective of general purpose financial statements, we said that the financial reporting, we say that the objective of financial reporting is to make sure that we provide what? Financial information. Going on. What I wanted specifically was that word, financial information. This financial information. If I'm to take you back a bit, just a few hours in our classes that we have had, when we were talking about financial information, what did we say? Can anyone remember? What is this financial information? If we are to so remember something about it. Could either be someone online or someone physical.
What I can remember, it is all about it shows the position of the entity, the financial position of the company.
The position of the entity. That is Maureen. Thank you very much. She's saying that what she remembers is that it shows the position of the entity. Position of the entity. I think this is okay. Shows the position of the entity. Now, okay, do you have any other person before I continue? About financial information? What we looked at? It is a very strong basis for to whatever we are going to be studying today. Yes? It is basically financial information is basically financial statements. Basically financial statements. That is another school of thought. Do we have another? Yes. Something to do with useful information to its users. Financial information is about the financial. Please mute. Ben of God. Oh, sorry. About the reporting entity. Guys, let's mute, please. Please mute. It's about the reporting entity. It talks about assets, liabilities, equity of the entity. And I think that is the position of the entity. Performance of the business. Okay. I think I've gotten enough information. I think this is all correct. And thanks a lot. The position, financial statements of the entity, equity, liabilities, that is okay. But if I'm to add something very small about what we looked at and what we called financial information in the basic terms, we said that we are interested in information about the economic resources on one side, not so? Guys, please mute. Shamim, mute. On one side, we are looking at information about economic resources. I don't know why my pen is misbehaving one of these days. So on one side, we are looking at economic resources of the entity. I don't think it will be charged. The economic resources of the entity. And on the other side, we are looking at claims, isn't it so? Isn't it? Claims against the assets of the entity. I don't know why it is misbehaving. Respective, we shall move. So those are two sides. And we said that it is these claims that we use to get what? To get economic resources, isn't it so? It is these claims that give birth to what we call economic resources. And what we call the economic resources, if we are to so derive, They're what we called the what? The assets, isn't it? Economic resources are assets. And then what we called claims, we said that these claims can be in twos, isn't it? And that is liabilities on one hand, and then equity, isn't it so? Equity is also a claim, isn't it? Both liabilities and holders of equity, they have a claim on the company's what? On the company's assets. Are we together? So, if I start my business, I gave an example that if we start a business with 50 million, that business is going to be in some form, that capital, that money is capital. What we use to start a business is capital, isn't it? So if we start with capital 50 million, that capital must be in a certain form. But for sure, that form must be an asset, isn't it so? That form must be an asset. We cannot say that we have started with capital in form of a liability. That can never happen. You start with capital and that capital is in a certain form, but that form is an asset. So meaning as you're starting with capital, one side, capital is 50 million, and that capital is in another form, which is an asset. So we are having equity, and at the same time, we are having an asset, depending on how you brought that capital. If you brought it in cash form, then it means that we are having an asset called cash. Are we together? If you brought it, if it is deposited in a bank, then we have an asset called bank. Are we together? So that particular capital is in form of bank. So in such a case, it means that the owners, if that is all we have, it means that the owners are claiming 50 million from the assets of the what? Of the business, isn't it so? The owners are claiming 50 million from the assets of the business. And I think it makes sense. It is true because the assets of the business are cash and what? Are cash or bank. So far, what we have. Are we together? That is it. And we also added something that if we go ahead and we employ a loan of 100 million, that loan is also going to come in a certain what? In a certain form. For example, if our cash in the first place came in form of cash, if our capital came in form of cash, then it means that we have on the other hand an asset of 50. And then on this hand, we are having capital, which is equity of how much? Of 50. If we employ a loan, that loan, it comes in a certain form. For example, that loan is deposited on our bank account, a business bank account. Then we are saying that we have on one hand a liability, an obligation to pay 100 million. Are we together? But that obligation has given rise to another asset, which is money in the what? Money in the bank. Are we together? At all times, those two are going to be moving in such a manner. And that forms an equation. And even in the first place, we saw that whatever you have as assets, they are coming from claims. These claims can be in twos, either equity or liabilities. Now, that forms what we call the accounting what? That forms what we call the accounting equation. The accounting equation. Now, the accounting equation, I don't know if it is because of sharing. I think it is because of sharing, because if I don't share, it works perfect. Okay. So what we call the accounting equation states that all assets must be equal to owner's equity plus liabilities. at all times. All our assets must be equal to owner's equity plus liabilities. That's what we are trying to say. And this, it gives back to what we call the double entry system of what? That gives back to what we call the double entry system of accounting. But before we go there, this equation here was built on a concept called duality. I am moving a bit slow because I want us to appreciate this from the grassroots, from the foundation. That equation was built from a concept called what? Called duality. That if we are having a business transaction, that business transaction must give rise to two sides. It comes in twos. Yeah, there is a dual effect in any business transaction. Are we together? Any business transaction gives rise to a dual what? A dual effect. There is a dual effect. And I think from the examples that I've given, we have been seeing some sort of a dual what? Some sort of a dual effect. A transaction, for example, bringing capital to a business, that is a transaction or an event. Are we together? You're bringing money to a business. But as you're bringing money to a business, that is forming capital. Are we together? But that capital is coming in a certain what? In a certain form. So there is capital and there is an asset. And by dual, it means sides. Are we together? It means what? It means sides. And as you're seeing that equation, it has two sides. I don't know if we are seeing two sides or three. Are there two sides or three sides? I think there are two sides. There is the left-hand side, which has assets, not so? And then there is a right-hand side, which has equity and what? Equity and liabilities. Now, for any business transaction, it must give rise to a dual effect. It must have a dual effect. It is either that effect is one arm of the effect is affecting the left-hand side, and another arm of the effect is affecting the right-hand side. Or one arm of the effect, or both the effects, the dual effects they are affecting one side specifically, but increasing one item and reducing another what? And reducing another item. That's how it works. So the effect is not that the effect, it must be affecting two sides. A transaction can come and its dual effect is affecting only one what? Is affecting only one side. Are we together? For example, I think we're going to be seeing examples. There is a certain illustration that we are going to. But if we have money, for example, using the example that we have been having, if we started our business with capital of 50 million, we started it with capital of 50 million in cash form. In cash form. Then we are going to say that that transaction has a dual what? It has a dual effect. And one effect is that we are starting a business with capital. Are we together? That capital is equity. And then that capital is coming in form of cash. Are we together? Which cash is an asset. It is a resource. Are we together? Now, that particular transaction, its dual effect has affected both sides, left hand and right what? And right hand. But let me bring this example. Assuming that after starting that business, we got some money out of the 50 million, we got 40 million and we banked it. Are we together? We got 40 out of the 50 and we did what? And we banked it. You have dropped something. I don't know if it is money. You might forget. Out of the 50 that we started with, we got 40 and we did what? We banked it. That is a transaction. It has a dual effect for sure, isn't it so? I don't know if we are seeing the dual effect. What is the dual effect there? We are having some money in cash form and we are translating it into bank. Are we together? So the dual effect is that we are having bank and we are having cash. Are we together? But if you're to look at bank and cash, all of them are economic resources. They are on one side. Are we together? But meaning the dual effect is going to only and only be felt on one what? On one side. But it can never be moving in the same direction. It has to be moving in opposite what? In opposite direction. As one element is increasing, another must be what? Another must be reducing if it is on the same side. Are we together? Just like the example we are looking at, we are having cash 50 and we are taking 40 into the bank, meaning the element called bank is going to increase. Are we together? Yet the element called cash is going to do what? It's going to reduce. Now that is what we call duality. I was left behind. I can't see what you are illustrating. I don't know if everyone is not seeing. Sorry? Guys online, are we able to see this?
I can see. Yeah, I can see.
Okay, I think people see. We can't see any movements. I'm not writing. I've been simply talking. What is on the screen is it is what is there. I haven't been writing anything. I was simply just verbally illustrating those examples. So this equation here that you see is what it is what gives birth to what we call double entry. And this equation here, it is built on a concept called duality. A concept called duality. And that comes from the purpose that we looked at, the objective of general purpose financial reporting. That the objective is that we are trying to provide financial information. Which financial information? Is information about economic resources and claims. Are we together? Economic resources and what? And claims. So far, that is where we are. But we later added that the same information includes changes in those economic resources and what? And claims. Isn't it so? Changes in those economic resources and what? And claims. And by changes, it means it is either a resource is increasing or a resource is doing what? Is reducing. Or a claim is increasing and a claim is doing what? Is reducing. And that gives rise to either an income or an expense. Not so. From our definition of elements, we saw that. So meaning, if I have only this equation, I have the entire business in my hands. Not so. Because I have economic resources, I have claims. If I have economic resources and I have claims, then I can have movements in those claims. And those movements, remember, when we are trying to explain the definition of an income and an expense, an income, we said that those movements give rise to an increase in equity. Isn't it so? Yet an expense, those movements give rise to a reduction in what? To a reduction in equity. Are we together? That is for an expense. An income increases equity other than contributions from the owners. I think we looked at that. Now, guys, this is what we call the equation. And at all times, this equation, just like any other equation, it must balance. Are we together? At all times, this equation, just like any other equation, it must what? It must balance. Meaning, as we enter a transaction, if we perform that concept of duality, then it will never change this equation. The figure might change, but the balancing will never what? the balancing will never change. If duality is done very well. Are we together, guys? All right. So let's look at some illustrations, I think. We are going to use this illustration here. That illustration. It has quite a number of transactions. We want to make sure that we come up with the accounting equation depicting each of those what? Each of those transactions to see how the concept of duality can be applied in the accounting equation. After understanding how duality works in the accounting equation, then everything is going to be very what? It's going to be very easy going forward. But maybe before I move forward, let me first try and explain further what we call this accounting equation. Because I see some people, it is like they still have some.
Excuse me, sir.
Yes, please.
According to that illustration, I'm requesting if you can send it in the group so that we can be following up with whatever we read and whatever we illustrate. If it works, I don't know.
Okay, no, I wasn't, I never wanted to send the entire presentation.
Okay.
But I think you can screenshot if you wish.
Okay, does it stop on here?
Yeah, that's where it stops.
Okay, let's
That's
first
where
check.
it stops. So just take a screenshot if you can.
Yeah,
But I'm going to keep referring to it, so I'll open it.
okay, thank you.
Yeah, the PowerPoint has very many other things that I don't want to share at this point in time.
It's okay.
But it is. Let me try to open this application on Chrome because here it is misbehaving a bit. Okay, let's try it here and see. All right, that is our illustration. Trying to see, of course, it would be rare, actually. It is so rare to find an exam asking for the accounting equation. I just fear to use the word impossible. But it is rare. Let me just stay at the word what? Rare. Let's try to use this illustration just to illustrate the concept of duality, because double entry, trust me, will be very hard if duality has not been understood. Yeah? And yet double entry is the backbone. All right. So we are saying that assets must be equal to owner's equity plus what? Plus liabilities. I wanted to first of all explain these terms. We said an asset refers to a present economic what? Present economic resource. Isn't it so? A present economic resource as a result of past what? as a result of past events. Are we together? Now, I want us to first of all dissect what we call assets here. The conceptual framework also talked about something to do with classification, and we say that these assets can be classified into non-current and what? Non-current and current. Now, keeping other factors constant, we have very many factors, but I want to hold them what? Constant. What are the examples of non-current assets? Sorry? Buildings. Buildings. Now, guys, I'm holding other factors what? Because buildings are non-current assets. But if someone is dealing instead of buildings, then they cannot be non-current. Are we together? I don't know if you understand. Another person is going to tell me that a motor vehicle. Yes, a motor vehicle is a non-current asset. But if I have a bond and my stock is motor vehicles, then motor vehicles cannot be non-what? So I'm holding factors what? Constant. So I have talked about motor vehicles. I can put them. Other examples, just to make life easier for other people. Furniture and fittings. Machinery. All these we are saying that they are non-current what? Non-current assets, because we expect to get economic benefit from them for a period of over 1 year. In actual sense, we are expecting them to stay in the business for a period of more than 1 year. Or if I'm to use a much more technical language, is that we are expecting to hold control over those assets over a period of more than 1 year. So we may not exhaust the list, but if you see that that is an asset, it meets the definition of an asset, but the entity is controlling it and it is going to be available for a period of over 1 year, then that is suitable to be called a non-what? A non-current asset. Are we together? We can also add land. Yes. A scenario where motor vehicles cannot be a non-current asset. I gave you one already. Eh?
In a bond, someone will not want to buy a up to 1 year. So it will be current. It
will be current in nature. You have
someone will come to want the country. Someone take 1 year to do the savings. Meaning you sell it for less than that. So to you as a bond,
they move from being non-current and they just become trading stock. Okay? And trading stock cannot be non-current because you trade with them, sell them, buy them now, sell them tomorrow, you get. So however much we are saying that a car is non-current, it is non-current to someone who is not in a business of selling them. You're just using them to run your operations. So that is non-current in nature. Are cars bought for employees considered as assets? Yes. But we are not giving them to employees to take them for good. We are giving them in the due course of performing their what? Performing the duties of our company. So they are assets to the company. Are we together? Those are the ones that we are actually talking about. Then, examples of current assets. We can talk about cash at hand. We can talk about the cash that we have in the bank. We have talked about inventory. Inventory, or what we call stock. Stock. Inventory. These are the reason that's why the entity is what? Is existing. Are we together? We are existing to sell such and such. That is inventory. If it is tangible. Are we together? For service organizations, they can never have inventory, maybe consumables. Are we together? Hey, you a saloon, can you have inventory? Maybe consumables. Eh? You can have inventory of levels. Eh? Men, when they go to salon, they put a level and then they do like this. Eh? Which other, these things that they put and then they put in the hair. Eh? Those ones, you can have that inventory. So it is possible, but it is for consumables. It is not that you're selling it. You're using it in offering the what? You're using it in offering the service. Yes. Other examples of current assets. Debtors. Sorry? Okay. But you're taking us very far. Let's not reach there. Yes, goodwill is an asset, but not current, of course. It is non-current, but let's first leave it for now. Eh? We shall look at that one later on in this very in our course, but in partnerships. So we are looking at debtors. Debtors, I will call them trade receivables or accounts receivables. Yeah. Trade receivables. They are called receivables because you're expecting to receive. Isn't it so? Yeah. So a data you're expecting to receive. If I have money that I am expecting to receive, that is an asset. If I am sure that I'm going to receive, meaning I have performed my part of the obligation. Okay. I have performed my bit. So it is you that I'm demanding. All right. Trade receivables or accounts receivables. Someone online had something to say?
I had accounts receivables.
Accounts receivables, yeah, it's the same as trade receivables, the same as debtors. Now, there are very many other assets, but let's hold it for now. We shall be adding on the list as we are moving forward, okay? All right. I wanted us just to avoid any doubt. We have to make sure that at least we look at these examples, so that people know what we're actually looking at. Are assets okay? Are we okay with assets? We are okay with assets. So someone can read a transaction and they say that, oh, this transaction is giving rise to an asset. This transaction, that's the reason as why we are looking at them actually. So that when we are reading a transaction, someone as they are reading, they say, oh, this transaction will give rise to an asset. So I'll have to recognize an asset. That's the kind of interpretation that we are going to be doing. Examples of liabilities. Still, liabilities can be non-current or what? Or current. If a liability is non-current, it takes like what form? Examples. Yes, what we call non-current, whatever obligation that you have, but a settlement of which will be required after 1 year. Are we together? After one what? After 1 year. That is non-what? That is non-current. So an example?
A long-term loan.
A long-term loan. Long-term loan, or we can say a loan of over 1 year. Are we together? That is a long-term loan, yeah. That is a pure non-current liability. You go to a bank, they give you a 5-year loan. That 5-year loan is a non-current what? It's a non-current liability. Do we have any other example? For now, let's keep at loans. We shall add on the list. For now, you have something? You have a loan, you have to pay it, you have a liability. Now, what we should have for now is that if it is an obligation and payment of which is going to be beyond 1 year, non-current, okay? Then current, if it is within what? Within a year, like?
Accounts payable.
Short-term loan, yes, accounts payables. Accounts payable. Accounts payables are the same as trade payables. Okay? And they are the same as what? Creditors. Please hold these names at on our fingertips. We need them. Creditors, trade payables, accounts payables. Any other example?
Short-term loan.
Short-term loan, we have it. Any other example of a current liability? Utilities, an expense.
Utilities are expenses.
Unless it is unpaid. Okay? But that is going to come later on. Okay? It is going to come later on as we are moving. It is an expense, but if you have already incurred it and you haven't yet paid it, then it is a liar. I don't know if you get my point of discussion. Rent is an expense, but if I've already slept in someone's house and the month is done and I haven't paid it, then that is going to become a liar. It's going to become a liability. It means that that rent is outstanding or accrued. Okay? And so that is an example of a current liability, but I'm not going to bring it now. We shall introduce it later. Rental fees. No. Maybe when they accrue. Okay? When they accrue, when they are unpaid. Okay? Have you heard of something called a bank overdraft? Is it short term or long term?
It can be both short term and long term.
But most of the scenarios are short. Okay? Can be both. But most of the scenarios are short. So current liabilities include a bank what? They include a bank overdraft. Bank overdraft, you have an account with a certain bank and you actually overdraw it, okay? You have 20 million and they give you 30, okay? You get more than what you actually have in that account. So the excess that you have overdrawn is a liar. It's a liability that you have to pay back. But most of the times it is payable within a period of 12 what? Within a period of 12 months. Are we okay? Then we are going to Mr. Equity, and here I need everyone's attention. Yes, please. Mortgages are liabilities. Okay? But which mortgage? What do you mean by mortgage to start with? Can you, to start with, explain the kind of, the nature of the mortgage? An example, just a normal example of a mortgage. He's talking about a loan that they give you to build a house. Now, in such a case, of course, that is a liability. Yes, I just wanted an example for someone to try and understand. If they give you a loan to build a house, or they build for you a house, okay, and you pay, then that is a liability, okay? And it is, most of the times it is long term, because it is hard for it to be short. Long term. Should we go to Mr. Equity, please? Unless we have a question. Do we have a question? No question. Now, equity. The biggest component of what we call equity is capital. Are we together? please don't misquote me. I don't mean biggest in terms of figures, but if someone is talking about equity, what sounds out the most in people's ears is what? Is capital. So number one, a component of equity is what? Capital. Capital. Or what we call share capital for limited liability companies. Are we together? Capital or share capital for limited liability companies. Because if you're not a limited liability company, then you cannot add the word share. It is simply capital. Are we together? Share capital. What else? He said something to do with income. Now, and specifically, please, specifically, we are keeping this at this level where we are. We are going to be bringing in very many other things after this level. Incomes fall under equity. And what do they do? What is their effect on equity? They increase equity. Isn't it so? Because when we are defining incomes in the conceptual framework, we say they are as a result of increase in what? In assets or a reduction in that lead to an overall increase in what? In equity. Isn't it so? That lead to an increase in equity other than contributions from owners of or from the holders of equity. Are we together? I think you can revisit that definition if you could. I have already put the other PowerPoint in the group. So you can always revisit it. Now we are going to say incomes. Incomes increase what? Equity. And capital, what does it do? Capital also increases what? Capital also increases equity. If we say that we have capital, then we have equity. If we have incomes, then we have what? Then we have equity. What else? Retained earnings. Now, if someone says retained earnings, he has simply just combined the two things, incomes and expenses, and they have just gotten the overall result. Are we together? Because if you get incomes and you less expenses, you get profit. Are we together? If you keep putting that profit in equity, it becomes retained what? It becomes retained earnings. Are we together? So for now, I'm not going to put retained earnings, but I'm going to put incomes, and I'm going to also put what? Expenses. But retained earnings is an excess of incomes over expenses over a given period of what? Over a given period of time. Are we together, guys? Please, I want you to understand these things from the basics, so that as we are moving forward, things are going to be easy. Then I'm going to put the word expenses here. Which effect do expenses have on equity? These ones specifically do what? They reduce equity. Incomes increase equity, share capital increases what? Increases equity, but expenses reduce equity. The same thing for an item called drawings. An item called what? Drawings. A drawing is if an owner of that business removes a resource from that what? From that business. Are we together? If you remove a resource from that business for personal what? For personal use, then you have made a drawing. That drawing also reduces your what? It reduces your equity. Please remember this, because I'm going to refer to it when we get to double entry. Are we together? All right, I think this is it. Let's go to our illustration. We do it, we leave this
Excuse me,
place.
sir.
Yes, please.
I have an inquiry. Usually business owners tend to contribute some personal money, maybe to pay salaries. Like it's not part of income, but it's your personal money. And I don't know how that can be categorized. Yes, I know it's equity, but basically what term can be used?
Any resource introduced to the business by the owner is capital. Any resource introduced to the business by the owner is what? Is capital. Now, just that Mary has looked at it in the perspective of clearing an expense. But before clearing that expense, you introduced that money to the business as cash. Are we together? So it was a resource of cash introduced to the business. Then you use that cash to pay off an expense. Are we together? That increases your capital.
Okay,
Is it
thank you.
okay?
Thank you.
All right. Let's move. Monica provided the following transactions for the month of December 2022 in relation to his merchandise shop in Machindia town. Formulate an accounting equation for each of the following transactions. We are going to formulate an accounting equation for each of the following transactions. Transaction number 1, he started his business with cash at hand of 50 million and cash at bank of 30 million. I want us to look for duality in this. Duality in this. He's starting with cash at hand, 50 million, cash at bank, 30 million. We say that whatever resource you use to start a business is what? It's capital.
Capital.
Either using it to start a business, even if they say that he started a business with a car valued at 20 million, that 20 million is what? Is capital. It is not necessarily cash. Are we together? So, as long as it is a resource you have used to start a business, that forms capital. So, if you are to look for duality from this, we are having capital on one hand, which is equity, isn't it so? And then we are having economic resources. This time around, we don't have one resource, but we have more than one what? One resource. But for sure, it is economic what? Resources. In terms of cash and what? And bank. Are we together? So meaning, as we are drawing up our accounting equation, we are going to say that our assets equal to equity plus liabilities. Guys, try to mute Jamie. So assets. From that transaction, we see that we have gotten an element of assets called cash, not so? Of how much? Of 50 million. And then we also have an element of assets called what? Called bank. Of how much? 30 million. Are we together? But this was as a result of capital. Are we together? It is capital that we introduced. And that capital is what? Is equity. So we are having capital of how much? Capital is 80 million. From that transaction, do we spot anything that gives rise to an obligation for us to record a liability? No. That transaction doesn't have anything to do with an obligation. So meaning that our equation, on the left-hand side, we shall have 80 million. On the right-hand side, we shall have 80 in equity and 0 in what? In liabilities. And I think it will balance if you get your 80 plus 0. That is 80, and then 80 on the left-hand side. Are we together? Are we together, guys? Yeah, it is okay. Assets equals to liabilities plus equity. It is okay. Guys online, are we together?
Yes, we are
Yes.
together.
Yeah, this is our first.
Together.
That is our first equation or our first transaction. Our second transaction, still it is going to be assets are equal to what? To equity plus what? Plus liabilities. Equity plus liabilities. So can we try to read it? The second one, it is saying that bought land of 18 million, which he paid using a check from ZY Property Consultants. So the land was bought from ZY Property Consultants, and we paid 18 million using a check. Can we sense some duality around here? Land is an asset, not so? And we are also using check. That is bank, isn't it? Some money in the bank. So you see that this time around duality is affecting the left-hand what? The left-hand side alone. And we say that once duality is affecting one side of the equation, then there must be an opposite nature. Are we together? One is increasing, another one is what? Another one is reducing. Even when it is affecting the two sides, there is opposite nature. The equal signs represent opposite. Are we together? Because we know from our QT, our basic mathematics, that once a figure crosses unequal signs, it becomes a negative if it was a positive, and becomes a positive if it was a what? Isn't that one the opposite nature? Isn't it opposite? That is opposite. And we are going to see when we are defining double entry that the word opposite is very key, very important. All right. So can we draw up our accounting equation? When you're drawing these accounting equations, the one you're drawing must be based from the previous one. Okay? So from the previous, we had cash of 50 and we have bank of 30. In our new accounting equation, is cash going to be changed or it is going to stay the way it is? Cash is remaining because in this transaction, there is nothing to do with cash. We are using money in the what? In the bank. Are we together? So money in the bank, which was 30, is going to reduce by the 18, isn't it so? And we get a new asset, which we are calling land. Now, in the nature of presentation, it is not so neat to start with current assets and then you bring non-current. It is better you start with non-current and then you bring what? And then you bring current. Given that land is non-current, it's better for me to start my equation with what? With land, which I have gotten. Isn't it so? And then cash, which is staying at what? At 50 million. Isn't it so? And then my money in the bank, which is reducing from 32 to 12 million. Now, has my capital changed? Has my capital changed? Not at all. My capital stays the what? My capital stays the same. Okay? That transaction has not given to any liability. No obligation. Are we together? Are we together, guys? Transaction number 3. Transaction number 3, what is it saying? He bought inventory of 10 million cash from ABC Limited. Bought inventory of 10 million cash. cash is going to be affected. Our cash is going to reduce, not so, in our new accounting equation. And then inventory, we are coming up with another resource because inventory is an economic resource, not so? Current assets, okay? So still, this transaction is going to affect only the left-hand what? Only the left-hand side. So our assets are equal to equity plus liabilities. I think our land stays, not so? We still have our land in our business of 18 million. And cash, what happens? From 50 to 40. And then our money in the bank, that one stays at 12, not so? Because we haven't tampered with it, it stays at 12. And then what are we getting instead? We are getting inventory of 10 what? Of 10 million. Now you see, you are actually changing very many elements. You're changing elements in your accounting equation, but capital stays the what? Capital stays the same. Are we together? Now, this takes us back to what we call the concepts of capital. We said we have the financial concept of capital and we have the physical concept of what? Of capital. The financial concept of capital looks at capital in its monetary terms and in terms of the purchasing what? Purchasing power. Now, we are trying to illustrate purchasing power, what capital can do for you. What you see, capital is staying constant, but it is changing a lot in your business. You're using the same capital to get that, using this capital to get the other, the position stays the what? The position stays the same. So our capital remains at 80 million. We have no obligation so far. And when we get an obligation, for sure, you will see that there is an obligation. All right. I think we are good to go, not so? We can see our transaction number 4. Transaction number 4, bought office furniture. Oh, okay, before that. Secured a DFCU loan of Yugi X 10 million, which was deposited on his bank account to be paid within 1 year. Do we spot the obligation? There is an obligation here. As there is an obligation, meaning it is going to affect one side, which is liabilities, we are going to have a liability of a loan, isn't it so? But this loan is going to be paid within 1 year, so it is short term, not so? It is a short term loan, the other side. And then this loan is coming in form of what? It is coming in form of bank because that money was deposited on the company's bank what? On the company's bank account. Are we together? All right. So how will the position be? Assets equals to equity plus liabilities. From our previous land has not changed, not so? So we still have our land worth 18, and then our cash, it is still 40. Then our bank, as per our previous position, bank was at 12. Right now we are adding 10 million, not so? So it is resting at 20 what? at 22 million. And then inventory is still 10 million. Our equity, which is capital is still how much? 80 million. And now we are introducing an item of a liability, not so, which we are calling a short-term what? A short-term loan of 10 million. We are including a liability simply because we have an obligation to pay back within 1 year. So here we have 10 million. Here we have 80 million. And I'm sure if you're to add here, you'll get 90 what? You'll get 90 million. The position remains constant. It doesn't change. Are we together? So should we go to number 5? We'll go to number 5. Please don't accept to be left behind. Number 5. Bought office furniture of UGX 5 million from Ling Ling on what? On credit. Bought office furniture 5 million from Ling Ling on what? On credit. Still, we have an obligation, not so? If you buy on credit, it means that you have not paid. Are we together? Now, this is what we call the accrual. You're not going to wait until you pay for you to say that now I have furniture. Are we together? Include your furniture in your books, and then you show us that you have an obligation. You have an obligation to pay. Okay. Furniture is a non-current what? Is a non-current asset. So among our non-current assets that we are having, we're going to include furniture. Then we shall also recognize another liability because we have another fresh obligation. Okay, so assets are equal to equity plus what? Equity plus liabilities. We have land of 18 million and we are adding now furniture. Furniture of how much? Of 5 million. The rest are going to stay the same. Cash of 40. And then bank of 20, of 22, not so? And then inventory of 10. Isn't it so? Has our capital changed? Our capital is still 80 what? 80 million. Then we still have our short-term loan of 10. And now we are adding a payable, not so? We are adding a payable in Ling Ling of how much? Of 5 million. Payable is a liability. We have an obligation to pay. So this is 15. And then this is 80. And I'm sure here we shall get 90 what? 95. I hope you are moving at the same pace. Pick the learning point. The learning point is being able to look at a transaction, pick out the effect in terms of elements. That in this transaction, we are having this element and the other what? And the other element. Are we together? That is it. Okay. And they are telling us that he sold half of the inventory for how much? For 6.5. He sold half of the inventory for 6.5 million cash. How much inventory do we have? We have inventory of 10 million. That is its cost. Are we together? That's its cost. And they're selling half of it. Half of it is how much? No, half of the inventory. Mary, kindly mute. Half of the inventory is 5. Are we together? Because that inventory that you're seeing under assets is there at what? At cost. Are we together? That's the cost we bought it. Are we together? So if we are to reduce it, you cannot reduce it by 6.5. 6.5 is the money that you got after selling. Are we together? But the cost of that sale is 5 million. True or false? The cost of that sale is 5 million. So my inventory has reduced by how much? By 5 million, not by 6.5. 6.5 is the cash that I got. Are we together? From sale of the inventory, which was worth 5 million. Are we together? So meaning my cash is going to increase by 6.5 because I'm receiving cash of 6.5. Isn't it so? And then my inventory is going to reduce by 5. Are we together? Now you see that the duality has not been completed, isn't it so? Because that is one side. You're increasing cash by 6.5, you are reducing inventory by 5. There is a 1.5. That 1.5 is a profit. And that profit is going to go under equity. Are we together? That 1.5 is going to go under equity as a what?
I beg your pardon on the profit made.
Now let's read the transaction again. It's a bit disturbing, but we need to appreciate it. He sold half of the what? Half of the inventory. 4. If someone says sold 4, meaning the money that they are going to state is what you got, isn't it? So sold half of the inventory for 6.5 cash, meaning we received the cash of 6.5. Are we together? But since we are selling half of the inventory, our inventory, which was 10, is not going to remain 10. Isn't it so? It is going to reduce by half. Are we together? So it is reducing by half. It is reducing by 5. Are we together? And since we are selling inventory that we bought 5 million for 6.5, then logically we are making a profit of 1.5. And a profit is an element of owner's equity. Are we together? It is like incomes, excess incomes over expenditure. Are we together? So I think we can write that down as our transaction number 6. Now, I'm not going to keep writing those things. For you have to rewrite. Yeah? Now, let me show you the changes. Okay, we are saying that what is going to change? What are we changing? Our cash is going to increase from 40 to what? To 46 point?
46.5.
46.5. $46.5. And then our stock is going to increase, to reduce, not so? By 5 million, isn't it so? Guys, you have to redraw this thing. Are we together? You have to redraw. Don't go back and you rap. Do as I say, not as I what? As I do. You have to rewrite. I'm trying to save time. I have to leave this place early. So, and then I'm going to introduce an item called what? Isn't it so? Under equity of 1 point what? Okay, so meaning down here, I will have 80 what? 81.5 million. My liabilities won't change. But for sure, my total here is going to change, not so? For how much? To 90 what? To 96.5. And I think it is still balancing, isn't it? Yeah. Should we move? Huh? Okay, part G, it is saying that he used a business debit card to take his family to the Ebony's family show for a cost of 800,000. Business debit card. Can debit card associate with cash? Eh? A debit card, can it associate with cash? A debit card will associate with a bank, not so? Money in the bank. Are we together? So he's using his business debit card to take his family out. So meaning our money in the bank is affected because he's using the business resources. Are we together? But is he putting this business resource to business affairs? He's putting this to family affair, not so? So this is going to bring what we call a drawing. Are we together? Yeah, it will bring what we call a drawing. So what is changing? Money in the bank is going to reduce by 800,000. And then capital under equity, we are going to introduce something called a drawing. Are we together? A drawing, and we shall put it in bracket to show that it is going to reduce, okay? This is how it is going to appear. So we shall have a drawing here of 0.8 million.
Excuse me,
Yes, please.
why are we introducing a drawing under equity?
Drawings reduce capital, ideally.
Oh, yeah, I get you.
Yeah.
Please excuse me.
Yes. Yes, Aisha, I think. Is it Aisha?
I have a question. I have a question on transaction 6. Isn't the 5 million supposed to affect equity?
Transaction number 6.
Yes, please.
Isn't the 5 million 1, 2, 3, 4, 5, 6? Isn't the 5 million supposed to affect equity? No. We are selling half of the inventory. Half of the inventory. So inventory is an asset. Are we together? So if we are selling, meaning the asset is reducing, inventory is reducing. Are we
Isn't
together?
it supposed to affect equity in any way?
It has affected it in terms of profit.
Okay.
The profit element that we made out of that transaction is equity. Is it okay, Aisha? This profit element here that you're seeing It came as a result of that transaction.
So we are supposed to ignore the 5 million?
Which 5 million? We reduced inventory by half, okay? If you're to look at your previous accounting equation, inventory was standing at 10, isn't it so? So we sold half of it.
Yes, I've
meaning
understood.
we reduced it from 10 to 5, okay?
Yes.
So should we move on? Is it okay?
Yes, please, it is okay.
Okay, so drawings, we are introducing drawings of 0.8, but negative. It is going to affect it negatively as you're adding. As you're adding down here, you reduce it. And then we are going to reduce the money in the bank from 22 million to what? To 21.2, isn't it so? So this is going to be 21.2. $21.2 million. Yeah. That is it. It's not so hard. It's not so hard. Are we okay?
Excuse me, sir.
Yes, please.
I don't know that. Okay, my question is when we are filling in these different elements on the side of claims, that is owner's equity and liabilities. I realized, for example, on number 4, you are inputting plus. Are we supposed to put them there, or we just put the transactions the way they are? Like, for example,
Plus.
capital and then short-term loan, yet the equation is owner's equity plus liabilities. So when we are recording these different transactions, we also put the plus.
You mean these?
Yeah, like here.
Eh?
Yes. Yes.
I was putting them. They're supposed to be there.
Like, I'm talking about the transactions down here. Are we supposed to put, like, for example, capital, short-term loan, profit, payable, stuff like that?
Okay, no. As you're putting those transactions, you don't have to put the plus.
Okay.
Once you put the plus in the equation, that is okay. It is sufficient.
Okay.
Yeah.
Thank you.
Okay. Paid Ling 3.8 cash. Paid Ling 3.8 cash. Paid Ling 3.8 cash. Meaning your cash is going to reduce by 3.8, not so? And then Ling was a payable, isn't it so? So the payable is also going to reduce. So I think that transaction is going to affect only cash and what? Yeah. I hope it is affecting here and where? And there. So it is going to affect cash. Cash is going to reduce by that figure because you're paying using cash. And then your payables are going to do what? To reduce, isn't it so? The rest are staying the same. Guys, you have to redraw. The same way we are doing, you have to redraw. I'm doing this because I wanted us to save time. I don't want us to leave late. Is it okay? So, when you redraw your accounting equation, cash will reduce by 3.8 and payables will also reduce by 3 point what? By 3.8. So meaning cash will settle at 40 what? 42 point what? 42.7, yeah? 42.7, and then payables are going to sit at 1.2, yeah? All right, I think that is it. Then the other transaction, paid salaries 1.2 by check. Paid salaries. Paid salaries 1.2 by check. Where are we having that effect? Our money in the bank is reducing, don't so? Our money in the bank is reducing for sure. Then under equity, that is going to reduce equity, not so? Or profit. So since you already have profit, you can simply just deduct it from profit. Okay? Yeah, just deduct it from that gross profit because you already have gross profit there. So there are two ways of doing it. Someone can choose to write salaries and they put it in brackets, or they just deduct it directly from the gross what? From that gross profit that is there. Okay, maybe that is 1.2. Paid salaries by check, meaning our money in the bank is going to reduce. We are paying by check. This 21.2 is going to reduce by 1.2 to rest at what? At 20 million. 20 million. And then we are saying that you can either reduce the profit. So if I'm to reduce profit, then I will have a new figure of profit of 0. What? Of 0.3. Or I can simply say we are paying what? Salaries. Or I can say salaries of 1.2 and I put them in what? Put them in brackets. I think that is also not so hard, is it? Then finally, we are saying he used 1 million from his salary for buying a mobile phone for his girlfriend. Sorry, this guy had a family and then he had a girlfriend. I hope ladies are not offended. So how do we account for this? Used Yugi X 1 million from his salary for buying a mobile phone for his girlfriend. This one is not considered simply because he's not using business resources. He's using his own personal what? Personal salary. So his personal salary is not a business what? It's not a business resource. Are we together? All right. So I think next time in our next class, what I will first of all look at, there will be the concepts. To understand the concepts before going to double entry. The different concepts. For now, let's call it a good night. Let's call it a night, sorry, and I wish you a good night. Any question? Yes? Mm.
How do I implement it? I rewrite that it was for I,
You rewrite as it was for I.
the equation, I rewrite.
Yeah,
Or
yeah. Just write it the way it is. Yeah. Rewrite the previous one. Yes? Yes. What if the salary accrues? Salary accrues, that is a liability. Yes. And at the same time, as it is increasing a liability, it is going to reduce your equity. Because salary accruing does not mean that you didn't incur it. That is going to be, I think, answered by the concepts we are going to look at next, okay? That we don't have to wait until we pay cash to recognize an expense or an income, okay? So if you have incurred the salary and you have just not paid it, it will reduce your profit and you recognize the liability. Are we together? Yeah. Is it okay? So that one is affecting only, such a transaction will affect only the right-hand side by increasing a liability and reducing equity, because expenses reduce equity. Had you paid it, it was going to reduce the other side. It was going to reduce cash. But since you have not paid it, it is rather increasing a liability. You get? Okay. Guys, have a good night. Till we meet again.